We'll now talk about the capital market line, or the CML. When investors share identical expectations about the mean returns, variance of returns, and correlations of risky assets, the CAL for all investors is the same, and this is known as the CML. A phrase that you might recall from level 1 is that the CML is a special case of the CAL when the expectations are the same. Expectations about returns, variances, correlations, when they are the same, then the CAL is the CML. With identical expectations, the tangency portfolio must be the same for all investors. So essentially what we are saying is that if this is your risk and this is the return, the minimum variance frontier becomes the same for all investors if all expectations are the same. The risk-free rate is obviously the same, and therefore the tangency point is the same. Just to hammer in the point, if expectations are not the same, then what happens? Then different investors will have different efficient frontiers. The risk-free rate will still essentially be the same, but you might have another investor who has a minimum variance frontier and an efficient frontier that's different. So there the tangency portfolio will be different. All right. So anyway, what we are now saying is that we have the same expectations. So there is just one efficient frontier, and therefore there is just one tangency portfolio. That tangency portfolio is called the market portfolio. It contains all risky assets in proportions reflecting their market value weights. Okay, so this is a theoretical construct. I want you to memorize this phrase. We will discuss it in more detail in other readings. But for now, just remember that the market portfolio contains all risky assets in proportions reflecting their market value. The CML formula is given right here. It is exactly the same as what you saw earlier with CAL, except instead of referring to the tangency portfolio, we are now referring to the market portfolio. Next, we talk about the capital asset pricing model, or CAPM. And you've done this at level 1. Here again at level 2, we first need to go over the assumptions. Assumption number 1, investors need only know the expected returns, variances, and covariances of returns to determine which portfolios are optimal for them. Now this assumption, you will notice, appears throughout mean variance theory. And in case you are getting a little confused about theories and models, the mean variance theory is your umbrella. Underneath this umbrella, you have the CAL, the CML, and CAPM. So all these are models that fall under the umbrella of mean variance theory. Because if you think about it, all these models are based on expected returns, or the mean returns, and the risk as expressed by variance. Assumption number 2, investors have identical views about risky assets, mean returns, variance of returns, and correlations. Number 3, investors can buy and sell assets in any quantity without affecting price, and all assets are marketable, which means that they can be traded. Number 4, investors can borrow and lend at the risk-free rate without limit, and they can sell short any asset in any quantity. And finally, investors pay no taxes on returns and pay no transaction costs on trades. All right, now this is the CAPM formula, and you would not be here if you did not already know this formula. You've seen it at level 1, and it's one of the most important formulas in finance. I'll just emphasize a few points here. What is CAPM doing? it is giving you the expected return of an asset based on the systematic risk. So RI refers to the expected return on a particular asset I. That is equal to the risk-free rate. So let me just draw this out. The graphical version of CAPM is called the security market line. What we plot on the y-axis is the expected return, and what we plot on the x-axis is the beta, the return of a particular asset. And then the SML looks something like this, where the intercept is the risk-free rate and the slope is the market risk premium. It is the expected return on the market minus the risk-free rate. And how do we know that? If this is your expected return on the market, then what is the y? It's this is change in y is the return on the market minus the risk-free rate. So I'll put that over here, return on market minus risk-free rate divided by change in x. The market has a beta of 1, so the denominator is 1, therefore the slope is simply RM, or expected return on the market, minus the risk-free rate. But then with the CAPM model, we are coming up with the required return on a particular stock. So the required return on a particular stock depends on the beta of that stock. Beta is a measure of systematic risk, and more precisely, beta represents the covariance of a given stock, or the covariance of the returns of a stock with the returns of the market divided by the variance of the market returns. Beta will vary from stock to stock because obviously the covariance of every stock with the market will be different. A stock with high covariance with the market has a high beta or high systematic risk. The CML represents the efficient frontier when the assumptions of CAPM hold. In a CAPM world, therefore, all investors can satisfy their needs by combining the risk-free asset with the identical tangency portfolio, which is the market portfolio of all risky assets. Now, you don't need to get too hung up with the details behind this, but just a high-level remark here, which is connecting CML, which we saw earlier. So earlier we saw the capital market line, where we have the risk of the portfolio on the x-axis, expected return on the y-axis. So all we are saying is that in a world where CAPM assumptions hold, the CML becomes the new efficient frontier. Very often students get confused about the distinction between CML and SML. So I am putting both those graphs on the same slide here. This on the left is the CML. And what do we have on the CML? The y-axis is expected return, x-axis is the risk of a portfolio, this is the risk-free rate, the slope is the Sharpe ratio, and as I just said, in a world where CAPM assumptions hold, the CML represents the efficient frontier. Here we are looking at the expected return on portfolio, and the measure of risk is sigma, or total risk. In the SML world, or when we talk about the security market line, the measure of risk is systematic risk, or beta. This applies to any security. So for any security, you come up with the beta, say beta is equal to 1.5, and the SML tells you what the required return is given this level of systematic risk. All right, now we are going to talk about some basic rules, or one of the simple applications of mean variance theory. Let's say you are considering two standalone investments, A and B, and you need to decide which one to invest in, either A or B. According to mean variance theory, here is what we do, and sometimes this is also referred to as the Markowitz rule. If the return on A, just to make it very simplistic, is equal to the return on B, but the standard deviation of returns, the riskiness of A is low compared to B, then obviously you should invest in A. And taking this further, if the riskiness of A is low compared to B and the return on A is actually greater than B, then obviously you still invest in A. So that is this point over here. What if the return on A is greater than B, but they have the same risk? Then obviously you invest in A. So this is straightforward. If we now say that we can lend and borrow at the risk-free rate, then we extend this discussion by saying that instead of simply looking at the returns, we should look at the excess return, the return over the risk-free rate. And since you also need to consider risk, we should therefore look at the Sharpe ratio. So when you are evaluating standalone investments, A and B, then you go with the investment that has the higher Sharpe ratio. And I'm sure you know the formula, but just to hammer it in, it's the return on a portfolio minus the risk-free rate divided by the standard deviation of the portfolio. One way of looking at it is saying that this is the excess return per unit of risk. To set the context here, I'll give you a scenario and then I'll explain this formula and then we'll work through example 6 in the curriculum. Let's say you are a portfolio manager and this is your existing portfolio. This existing portfolio has a certain Sharpe ratio. All right, let's say that the Sharpe ratio is 1.2, just picking a number. And you are now evaluating a new investment. You need to decide whether this new investment should be added to your existing portfolio. How do you make that decision? The answer is given right here. Actually, before I go to the answer, let's just consider what are the variables you will look at in deciding whether to add this new investment to your portfolio. Clearly, you need to look at the Sharpe ratio of the new investment. So let's call that Sharpe ratio new. And you should also look at the correlation between the new investment and the existing, because as we've discussed before, if the correlation is low, then the diversification benefit is going to be high. So here now is the specific relationship that you look at, and if this relationship holds, then you add. You look at the Sharpe ratio of the new. The curriculum gives the full Sharpe ratio, but I like to just say, okay, Sharpe ratio of new. If this is greater than the Sharpe ratio of your existing portfolio, so Sharpe ratio of existing portfolio times the correlation between the new and the existing. So if this holds, then you add. If this does not hold, then you do not add. All right, now given what you've learned, I want you to do example 6. This is actually an adaptation of example 6 in the curriculum, but the numbers are the same. So for Eurobonds, we are told that the Sharpe ratio is 0.1. Compare this with the product of the Sharpe ratio of your existing portfolio and the correlation. So this product is 0.105. You do not add, because for the new investment, the Sharpe ratio is actually less than 0.105. This condition does not hold. Therefore, you do not add Eurobonds. What about non-US equities? Here the Sharpe ratio is 0.3. 3. You compare 0.3 with 0.25 into 0.67. This is higher and you invest. But this illustrates something that is obvious. You don't actually need to do the second calculation. The moment you see that the Sharpe ratio of the new is higher, then obviously you can add, because all the correlation is doing is bringing the number down anyway. So this is fairly obvious. Where this relationship helps you the most is when the Sharpe ratio of the new investment is a little less than the Sharpe ratio of your existing portfolio. And there correlation becomes important, because there you are seeing that even though Sharpe ratio is lower, does the low correlation give us sufficient diversification benefit to still add the new investment? We now come to section 3, practical issues in mean variance analysis. This has two subsections. The first has to do with estimating inputs for mean variance optimization. We look at historical estimates, and then we look at the market model estimates. Then over here, we will look at the adjusted beta, which is something you've actually seen before in equity. So it's the same concept. Then we look at instability in the minimum variance frontier. All right, first let's talk about historical estimates. The larger point here is that we've been saying over and over that when we do mean variance optimization, or when we are talking about the mean variance theory, what do we need? We need return data. So we need expected returns, we need the variances, we need the correlations or covariances. So how do we come up with these inputs? One way of coming up with the inputs is to look at historical data. So you say that the historical data is a reasonable indicator of what will happen in the future, and you come up with the expected returns, variances, correlations using historical data. A lot can be said about this, but I'm going to emphasize the main points. Let's consider an N-stock portfolio and say that we go with one of the examples we've talked about, and we have a 24-stock portfolio. For this, how many expected returns do we need to come up with? So we'll need 24 expected returns. How many variances do we need to come up with? 24. How many covariances or correlations do we need to come up with? And I often use covariance and correlation interchangeably because there's a simple formula that connects the two. So you need to know this formula, and you've seen it at level 1 also. The number of pairwise correlations is n into n minus 1 over 2. So in our case, that's 24 into 23, all this divided by 2. So this is equal to 276. Okay, so just know that. But from an exam perspective and from a real life perspective, you need to understand the limitations of simply using historical data. One is that the quantity of estimates needed may be very large. Even in a relatively straightforward 24 stock portfolio, we need approximately 325 estimates. That's a lot. Okay, imagine if this is 50 stocks, then clearly the number will go up a lot, largely because of the number of pairwise correlations. So this is one issue. The other issue is that historical estimates of parameters typically have substantial estimation error, and there are two components here. One is that when you come up with expected returns or you come up with variances, you are sampling from a population, and then you are using the sample statistic to come up with an estimate of your population parameter. And if you recall from level 1 quant, when you sample and you come up with estimates of your population, there is going to be some sort of a sampling error. Therefore, clearly, even your method of coming up with data involves an error. So that's one issue. The other issue is that these estimates change over time. So if you have expected returns over a given point in time, then over another time period, the returns will be different. So those are some issues. Now, just keep in mind that this problem is very serious with regards to mean returns, and it is also serious with regards to variance, because mean returns tend to change over time. The other issue, the variance, however, does not change that much over time. So not such a big problem with variance. Just remember that. Next we come to market model estimates. So first I'll make a larger point. Asset returns may be related to each other through their correlation with a limited set of variables or factors. Now, why are we making this remark? Recall, one of the issues with the historical method is the number of estimates you need to come up with. So it would be nice to find a model where we don't have to deal with that many estimates. So if we can find some variables or factors such that lots of asset returns are related to those variables, then we don't need to come up with that many estimates. One of the simplest models that falls in this category is called the market model. This model explains the returns on a risky asset as a linear regression with the return on the market as the independent variable. So this is the formula then. The return on a given stock is alpha plus beta times return on the market. In this case, what's the factor? The factor is the return on the market. And what we are saying is that this is an important factor because all stocks have a return which is related to the return on the market. And how do we define that relationship? It is defined through the beta. So rather than figuring out the covariances and correlations of every asset with every other asset, what we are simply doing is saying that the underlying important factor is the market return. So let's just consider the relationship between a given stock's return with the market return. So that is the huge simplification that happens through the market model. Now, let's say we make a few more assumptions. We have this regression equation where the independent variable is the market return and the dependent variable is the return on a given stock. And then we make assumptions which should sound familiar because you've seen these in quantitative methods, level 2 under regression. Say that the expected value of the error term is 0. With this assumption, the relationship here can be rewritten like this. So the required or the return is alpha plus beta into Rm. The market return is uncorrelated with error terms. So this should be one of the assumptions that you remember from before. And the error terms are uncorrelated among the different assets. So these are three assumptions. Now, given these assumptions, the market model makes the following three predictions. The first one I've already highlighted. The second one is that the variance of returns of a stock can be given by this expression. This might look complicated, but all we are doing is the following. We are taking this expression and saying the variance of returns is equal to the variance of all this. What is the variance of a constant? That's 0. So then we are left with the variance of beta I Rm squared plus this error term. Then since the beta is a particular sensitivity, that can be pulled out. So we have beta squared into the variance of the market plus the variance of the error term. Now, this expression over here, the beta I squared into sigma m squared, this is the systematic risk of I. If you have a well-diversified portfolio, then the variance of your stock that is connected to the variance of the market, that is not something you can avoid no matter how diversified you get. So this is the systematic risk. What about this variance? We said that the expected value of the error term is 0, but does that mean that the variance is 0? No. You can have something with an expected value of 0, but it varies around 0. So it will still have a variance. That is called the non-systematic risk of the asset. So if you just invest in that asset, this is a risk that you have. As you keep investing in more and more, this term moves towards 0. Okay, and then the third point which you need to remember is that the covariance between the returns of two assets is equal to the beta of the first asset times the beta of the second asset times the variance of the market. So these are relationships that you need to remember. Now, from here to here is simply the formula that connects covariance and correlation. So if you remember, what is the formula for correlation between asset 1 and 2? It is equal to the covariance between 1 and 2 divided by the standard deviation of 1 and standard deviation of 2. So if you remember this relationship, then this ugly looking expression makes a lot of sense. This is the covariance which we have shown over here. And then what is this thing? This is an expression raised to the power of half. That is the variance and the square root of variance. And this is the square root of variance for the second asset. All right, so you need to remember this because we will use it in the example on the next slide. But before I go there, just one point. We can use the expression for covariance from the market model to greatly simplify the task of estimating the covariances needed to trace out the minimum variance frontier. So this goes back to the point I made when I started discussing this slide, which is if you think about historical estimates, there you need to make a lot of estimates. But if you make this simplifying assumption that the market return drives other asset returns, then the number of estimates you need is so much lower and your calculation becomes so much easier. All right, now I want you to do this example. It might look complicated, but it is simply an application of the formulas that we just talked about. So this is the correlation formula, and I think this is important because it connects the items that we've talked about. This was the covariance that we just saw. This was the standard deviation for each of the two assets. Here our two assets are Cisco and Microsoft. And in this example, all the numbers are given. The betas are given. The variance of the market is given. That's right here. So what about the variance of the error terms? Those are also given. So it's just a plug and play. When you plug in the various numbers, this is what you get. So the market model predicts that the correlation between the two assets is 0.45. Okay, adjusted beta. And again, this is something you've seen before. Before I work through the material on this slide, just a basic point. Beta is considered to be mean reverting. So beta in the long run reverts to a value of 1. If a given asset has a relatively high beta, say equal to 1.5, over time this is expected to come down. If a given asset has a low beta, over time it comes up. Now, given that all the work that we are doing here is based on expected returns and expected risk, we should not take the current beta, we should make an adjustment to that beta. And how do you make that adjustment. Essentially, what you take is the historical beta as your starting point, and then multiply that by a certain coefficient and add another coefficient. The most common numbers to use for the two coefficients are 0.33 or 1/3 and 2/3. Okay, over and over both in this reading and in earlier readings, these are the typical or the most common adjustments. Can we have other adjustments? Yes, but if that is the case, then on your exam question, those other coefficients will be given. Most likely, though, it will be 1/3 and 2/3. So how do you make the adjustment? You just, let's say an asset has a beta of 1.5. So you do the calculation, the adjusted beta is 1.33. All right, next point. Instability in the minimum variance frontier. A problem with standard mean variance optimization is that small changes in inputs frequently lead to large changes in the weights of the portfolios that appear on the minimum variance frontier. This is the problem of instability. So the point here is straightforward. You do this elaborate exercise, you come up with the efficient frontier, you come up with your CML or CAL, and then you realize that there is a mistake or there is a change in the value of expected returns. When that happens, the efficient frontier changes, and if the efficient frontier changes, then obviously your tangency point changes and your whole model is off. So you need to recognize that this whole model is very sensitive to the inputs. The problem of instability is particularly important because the inputs are often based on sample statistics which are subject to random variation. And I made this point before also, that where do you get your expected returns or variances from? You pick samples which you use to predict the population, and clearly there will be sampling errors. The other point is that the estimates or the values for asset returns also change over time. So there isn't a whole lot more to discuss here. As long as you understand these points, you are covered. Example 8 actually illustrates this point. I don't think you need to go into too much detail, but I'll emphasize the core message from example 8. What we are given here is the following. For 3 different time periods, the 70s, 80s, and 90s through 2002, we are given the average returns for S&P 500, small cap stocks, ex-US stocks, and long-term government bonds. We are also given the risk of each of these asset classes, so in terms of their standard deviations, and we are given the correlation matrices. On this slide, I've only shown the correlation matrix for 1970 to 79, but the other correlation matrices for the other time periods are also given. And then over here, you see the different minimum variance frontiers. In the 70s, the minimum variance frontier looked like this. In the 80s, it was like this. In the 90s, it was this. So what's the point here? The point is that every decade we have a different minimum variance frontier because the inputs are changing. All right, next we come to multi-factor models. I'll read this excerpt from the curriculum that introduces this concept. Multi-factor models have gained importance for the practical business of portfolio management for 2 main reasons. First, multi-factor models explain asset returns better than the market model does. Second, multi-factor models provide a more detailed analysis of risk than does a single factor model. So CAPM is our classic single factor model. And if you think about CAPM, what is it saying? It is saying that the return on any stock is predictable purely based on the risk-free rate plus a beta of that stock multiplied by the market risk premium. So we are just saying that returns are predictable based on only one factor, the market premium, and then obviously the sensitivity of a given stock to that factor. We are ignoring all other factors. What multi-factor models try to do is say that, look, there are other factors which also help drive returns. So what will we cover in this particular section? We'll talk about what exactly do we mean by factors and what are the different types of multi-factor models, then the structure of macroeconomic factor models, arbitrage pricing theory, then the structure of fundamental factor models. This will look familiar because you will have seen this material in equity. Fema, French, Pastor-Stambo, these are examples of fundamental multi-factor models. Then we'll talk about some models that are used in practice, a few applications, and then some concluding remarks. Okay, so let's look at factors and types of multi-factor models. So what is a factor? A factor is a common or underlying element with which several variables are correlated. The classic factor that we've been talking about so far is the market risk premium, and we are saying that the various stock returns are related to the factor here, which is the market return. But as you will see, there are several other factors that also potentially drive returns. Systematic factors affect the average returns of a large number of different assets. These factors represent priced risk for which investors require an additional return for bearing. So when you take on market risk, that is an example of priced risk because investors can demand a return. If you take on non-systematic risk, that is risk, but it's not priced risk because you do not get an extra return for that sort of risk. Okay, now what are the types of multi-factor models? We have macroeconomic factor models. The factors are surprises in macroeconomic variables that significantly explain equity returns. So you expect a certain number for interest rates moving forward, and based on that you have certain equity prices. But if interest rates are lower than expected, then it turns out that equity prices are going to be most probably higher than what was originally expected, and we'll see this in detail. Then we have fundamental factor models. The factors are attributes of stocks or companies that are important in explaining cross-sectional differences in stock prices. So if we take the Fema French model, for example, in addition to the market risk premium, we also had factors that were related to the size of the asset. We also had a factor related to the book value to market value ratio. And then a third category which we don't spend too much time on, so I'll just say all that needs to be said here and then we'll move on. Statistical factor models. Statistical models are applied to a set of historical returns to determine portfolios that explain historical returns in one of two senses. Okay, remember, so we are talking about portfolios that explain historical returns. So what's sense number one? In factor analysis models, the factors are the portfolios that best explain or reproduce historical return covariances. So this is the first sense with covariances. Then the other is in principal components models, the factors are portfolios that best explain or reproduce the historical return variances. The curriculum doesn't give us examples here and doesn't go into much detail, so I will also just leave it at that. Okay, let's now talk about the structure of macroeconomic factor models. So this is the basic structure. You have a return, then you have a variable, or this is not a variable, this is the return on a particular stock. and then sensitivities and factors. This is best understood through one particular kind of a macroeconomic factor model, which is shown right here. Now, what does this tell us? The return on a given stock I is equal to AI, which refers to the expected return on that stock, plus BI times the factor for interest. Now, what does the factor mean here? The factor is a surprise. So F interest is the surprise in interest rates. We expect a certain level of interest rates. If that is actually what happens, so if the reality is the same as what's expected, then what does this number become? It becomes 0. And then this beta is the sensitivity of a certain stock to the interest rate surprise. Is it conceivable that some stocks will be more sensitive to interest rate surprises than others? The answer is yes. That sensitivity is captured here in the B. The B is a factor sensitivity. It is a measure of the response of return to each unit of increase in a factor, holding all other factors constant. And then we are saying here that the return also depends on surprises in GDP growth. And then there is an error term. So let's do example 10 now. We have a 2-stock portfolio, and I want you to try this before looking at the solution. So let's work through this. Note the following. So we are using the basic model that we just talked about, where the return on each stock depends on the inflation surprise and GDP. Actually, earlier we were talking about interest rates, but these models will be given to you. Why is this a macroeconomic model? Because the return is depending on macroeconomic variables. All right. You are told that in a given portfolio, we have 1/3 in Manumatic and 2/3 in Nextech. Formulate an expression for the return of the portfolio. So all we are doing here is taking this expression and saying, let's multiply that by 1/3, and then taking this for the return, expected return on Next, and multiplying this by 2/3, and then adding the 2. So it is just some tedious algebra. When you do this, what will you get? You will get some constant number, which will be 0.09 into 1/3 plus 0.12 into 2/3. Then there will be something times the factor for inflation. So something multiplied by the factor for inflation. There will be something multiplied by the factor for GDP. And then there will be 1/3 into the error term for Manumatic and 2/3 into the error term for this. If you actually do the working, this is what you will get. So the return for the 2-stock portfolio can be modeled as follows. 0.11 is that constant, and then you have these other terms which you have arrived at algebraically. What's the interpretation of 0.11? The interpretation is that if there are no surprises in inflation or GDP growth rate, then what is the return that you can expect? It is 0.11. So that was actually question number 2. What happens if there are no surprises? And then what was question number 3? Question number 3 said that surprise in inflation and GDP growth are 1% and 0%. So there is no surprise in terms of the GDP growth number, but inflation is 1% higher than expected. We are also told that the error terms are 0.5%. So what we do is plug into the formula that we arrived at over here. For inflation, you plug in 1%, and remember, always safer to work in decimals. So you plug in 1%. For the GDP surprise, you plug in 0, and then 0.5% becomes 0.005. You plug in these numbers and you have a expected return of 12.5%.